Good afternoon, everyone, and thank you for joining us on the webinar this week. We're going to be talking about property development finance, and we're going to concentrate on sort of ground-up residential development. I'm Paul Keddy. I've sort of been working at Mortgages for Business for just over 3 years, and I have sort of 37 years experience for my sins with the RBS group. I've sort of been dealing with property development myself for approximately 25 years, sort of lending in that arena. Last year was a great year for us on the property development side of things. I negotiated and had drawn down some £40 million worth of property finance in 2018. So I'm going to run through this webinar, but can I ask you to sort of keep your questions to the end, and then I'll run through those questions with you once we get through this short presentation. So the presentation is going to consist of what experience is needed, the size and type of development, the land, planning permission, costing the development, profits, lenders and how much you can borrow, a couple of examples, and sort of the application process and timescales. So let's crack on. Let's have a look and see what property development brings to the party. So the first thing that the lenders always consider with a property development is the experience of the developer. So the more experience you have in development, the more opportunities and the more options you have regarding funding. So it doesn't mean that if you haven't got experience, you can't borrow for a property development. It just means your options are limited. So let's see what sort of experience they're looking for. So if you're looking to do a development, the lenders like to see that you've done a development of a similar nature. You've done a new build in the past, you've done 2 or 3 new builds in the past, or that you've built a very large extension. So just some form of experience of a similar nature, having to dig out the footings, etc. And then it may be that you've not done any development yourself, but you have been making developers profits by actually working on site in the construction part of the development process. So you could well be a civil engineer, an architect, a bricklayer, groundworks contractor. So if you've been involved in development, that is a really positive feature to have when you apply for development funding. Another aspect is you may have a skill set that fits in well with development. And development is like, it's like a project. You've got to pull different arms together to make this thing work. So if you've been involved in project management, that's a good skill. Or if you've been an accountant and you know how the figures work and how you need to see a profit, that's important. If you've been a landlord and you understand properties and how you lease them out and how the property market works, you can then sort of know what your target audience is once you've completed the build. So that's sort of experience that's needed, and you need to get and put an excellent CV together. So you've got to maximize all your positives in that respect, and that's where we come in to help you do that. So moving on to the next slide. As you can see from these lovely pictures, there are a wealth of different types of development. I suppose the easiest one could say a detached property, so a single unit. That's quite straightforward. It's sort of just encompassed on its own, so you don't have sort of issues regarding adjoining properties. So that's quite positive. Then you have a look at sort of to the extreme, sort of a housing estate, where you put up a number of properties. That can be that you need to phase it over a period, because really the funding, you cannot fund building the 300 properties at once, but you might need to do 2 or 3 phases. So you have a look at that. Blocks of flats, that is another form of development. So you're going up a number of floors there. So that's important as well. So you can see from there, terrace houses, you get economies of scale because you're building it in bulk there. So there are plenty of properties and development types. And then, of course, there's the land. Where is the development going to be? And a lot of people will phone me and say, "Oh, I've got a plot in my back garden that we'd look at." And it's really where that back garden is, to be honest. You can see that nice green land there on the first picture. It may be very difficult to gain access to that land, so that could cause an issue. I've had plots before in the middle of town centres where the plot's very squeezed in, so it's very difficult to get the machinery, the materials into the site. And because of the noise on the site, you're limited to when you can work. And yeah, we have an extreme example there of unstable. But yeah, you have to have a look at sort of what is the land, how's the land? Do you require sort of pilings for the foundations? So you have to look at those aspects. On a slope, what are the groundworks required? The more groundworks you have, the more expensive it costs. Yeah, I don't think I've ever done a development with quite as much water around it, but I've dealt with sort of some major basement dig outs, and we've had to sort of look at sort of how we contain sort of the water table and how we tank out the basement. And lastly, the old environmental issue next to a petrol station, contamination. You've got to consider those factors when looking at the land. Also, with the planning permission, development funders, you can have sort of two types of planning permission. You can sort of have the outline planning permission, which sort of gives you sort of a very rough guide of what will be permitted. But the lenders really like to have the full planning permission required before they draw down. And you can have all sorts of things contained, that the lenders are going to look at in respect to the property. Rights of light, for example. I had a development where property was built next to another one, and because it was slightly higher, it was cutting out the light from one of the windows. So there was quite a debate about the rights of light there. But as the window was only sort of doing the staircase, we managed to get sort of work with the surveyors, etc., to get a letter saying there won't be any issues with regard to rights of light. And then you've got easements. Do you need access across other bits of land or land chart or mortgage to another lender? That needs to be put in place for rights of access. And then environmental issues. I've seen many of these environmental issues. Protected species. I've the Dartford warbler, great crested newts, bats, to name a few. And of course, we have this community infrastructure levy, the old 106 agreement, which is a charge that the councils put in place for community services. So if you build a number of properties, they more likely ask for a SIL payment. So you really need to know when is that payment due and how much is that payment. So it factors into your profitability side of things. So also the planning permission, it's not on that slide, but you need to see how many conditions are on there and are they fulfillable. That is very important. I have had a situation where someone got planning, but they put 123 conditions on it, which in essence meant that the planning was declined because there's no way they could fulfill all those conditions. So you need to look at that as well. So yeah, just looking at development, these figures vary around the country here, but I sort of having a look at sort of professional fees and how much it costs for a build. In the southeast, at the moment, it's a very succinct number here, £143 a square foot. But that is sort of the average build cost. But if you're doing it yourself, doing the construction, you can bring that down. But we have to sort of make the lender aware that is why we brought that down to sort of near 120. £110 a square foot. And obviously with a basement, I spoke about basements before, £200 a square foot, digging out, tanking, removal of soil, that puts the price up quite considerably. And then sort of the lenders always want the property at the end of the day to be marketable and have a good marketable title. So I put an HBC warranty. other warranties are available. There are a number of other warranty companies, but you need that. If you don't have a warranty on your completed build, you will find it be very difficult to sell or even obtain a buy-to-let on. And of course, you have other costs involved, health and safety, more and more. And then the potential fees, you've got your legal fees, you've got, so you've got the solicitors, they do like to take a little cut. Surveyors for the valuation, obviously, what happens is the lender will get a valuer to go out to the property, value the property as it is with the benefit of planning permission. Then they would have a look at the build costs in just general terms and say, well, that looks about right. And then they will say, and the end value is going to be X. So they do sort of 3 bits of the valuation, but those valuation fees can be a little higher than anticipated. So you've got to take those in. And then depending on the size of the development, you would need to have, or the lenders tend to have, an independent monitoring surveyor. This is a surveyor that comes out, firstly analyses all your build costs, etc., and sort of rubber stamps them to the lender saying they look about right, and also the timeline looks about right. You can complete the project within that time. And then every drawdown, when you sort of start drawing down the development loan, they'll come out and say, oh, that much work's done, that's fine, report back to the lender, and the monies are drawn down. And dare I say, there are arrangement fees from the lenders. They do vary, and we'll go on to some examples of that in a minute. And us brokers like to be paid a little bit, so we have a broker fee. And of course, when you buy it, there is stamp duty to consider. So I said we'd do a couple of examples. This, I chose an end value of 100,000 because my maths aren't very strong, so it makes the calculations a lot easier. But from experience, we see developers, professionals in the game looking for a 25% profit on cost and a 20% profit on gross development. Now, lenders are always looking at these 2 ratios, and they can move. I mean, they can move down sort of 20% on cost and 15% on gross development value, but I don't think they would want them much lower than that. So it's showing that you're getting an appropriate return for the risk you're taking at the end of the day. So with this particular example, as I say, very rounded figures, but 25k for the land, 55k for the build, total cost 80, end value 100. Great news, we've made a profit of 20,000. So what that means is 20,000 compared to 100,000 is 20%. So he's made a 20% profit on the gross development value, and he's made 20,000 on the money he's spent, 80,000. So he's made a 25% profit on his costs. So happy days. So that's just an example for you. Now, how much can you borrow? That's a question I get asked quite a bit. Most people want to borrow as much as they can, but the more you borrow, the more it costs. So we will go on to sort of what lenders look at in terms of how much you can borrow, but the more you can put in, the better. The rates on that fall away. But one thing you need to remember is that you need to put your cash in first. Now, it used to be in the days before 2007 that you used to be able to put your 40% in on land purchase, and then when it came to development, you could put your 40% in at that point. However, a lot of the lenders had their fingers badly burnt in that the cash ran out, there wasn't enough to finish the development, so they had to fund the rest of the development. So they've changed their stance and say we want the cash in first. So, as I said, there are a number of lenders. There are the high street banks, your Barclays, HSBC, NatWest, Lloyds of this world, who will lend at lower sort of percentage ratios. So they would lend typically 60% of costs, as long as that's no more than 50% of GDV, i.e. the end development value. So, I mean, that's quite conservative, but the rates are reasonably attractive at 4.5% above sort of bank base rate. So bank base rate at 0.75 today, so you're looking at 5.25. And the term of the loan, they vary from 12 months to 24 months. My viewpoint is go for the longer term, because of the fact that if you haven't sold in 18 months, you're going to have to pay to extend it. So go for the longer term. And the interest is rolled up on these loans throughout, so you don't need to cover the interest. They take an arrangement fee, typically 1.5% of the loan, and now an exit fee also features of 1.5%. But pleasingly, it's of the loan amount and not the end value of the property, which some lenders do. So looking at the tier one lender, i.e. the banks that we were talking about, and the example of 100,000 that we used before, in this case, 60% of costs amounts to 48,000, and GDV is at 100,000, so half of that is 50,000. Unfortunately, they take the lower of the two, so they were looking at sort of lending 48,000, total cost 80, so you would need to put 32,000 into the project on day one. So that means you buy the land of 25k, and then you put the first 7,000 towards the build costs. So I hope that explains sort of how they sort of structure you putting the cash in first. Now, pleasingly, there are challenger banks out there that sort of lend a little bit more, and they lend a typical. We can get a little bit higher than this, but this is a typical one: 75% of costs, as long as it's no more than 60% of GDV. Again, the lower of the two. But there is an excellent rate out in the market at the moment from one of these lenders, which is 7% fixed. And with sort of the world as it is, or Britain as it is in the moment, sometimes it's quite nice to have that knowledge that that interest rate is going to stay stable. So they do that. Like the banks, they do sort of up to 2 years on the loan, and interest is rolled up. Their fee is an arrangement fee of 1.5, similar to the banks, but the exit fee is slightly higher at 2%. But as you can see, I have reworked this using their sort of scenario. If you rework this using their scenario, you will be able to get a little bit more money out of the lender. Okay, so we have a third lender. As I say, they can lend up to 85% of costs. So all you need to put is 15% hurt money into the deal, which is to be no more than 65% of the end value. The rates are considerably higher, though. You're looking at rates of between 8 and 12%. These are variable rates linked to LIBOR. Again, 2 years being the term, the maximum term, with interest rolled up. The arrangement fees go up at 2% for the arrangement fee, exit 2%. So you can see the more you borrow, the more it costs, as you'd anticipate. But I mean, in risk terms, the rates are considerably higher. Now, you have to be careful when you approach the banks for lending, because you can get only one bite of the cherry with each lender. What we do here at Mortgages for Business, we help you put the business plan together and present the case to the lenders in a format that they prefer and understand. And we approach them very quickly, and we get a decision in principle within, once we get all the paperwork, within 24 to 48 hours. The high street banks, the tier one lenders, like a meeting on site, and I tend to go along to those because it's quite nice. I speak their language, having worked for a bank for 37 years. I know what they're talking about, and I can steer them in the right directions, and which really helps them and makes their life easier when they approach their lending department. They don't actually have an application form, so that makes it quite straightforward. You haven't got a lot of form filling. It's really our business plan that we put together, and they just write a report themselves to their credit team. And it takes them, a week to come back with a response from their credit team. The Tier 2 and 3 lenders, they also would like to visit you on site, and I go along to those meetings as well. But they do have sort of application forms that need completing that I must say aren't particularly user-friendly in many cases, but we do help you fill them in. We don't leave you there to drown in paper. And then, once we've got that decision in principle, we've got all this information, and we've got the lender's credit team to say yes, the offer is issued, valuation instructed. Hopefully that comes back positive, and then it's over to legals, and once they've completed their due diligence, funds are released. The sort of information that's expected is straightforward. You've got proof of ID, which is you do in every circumstances. Some proof of income if you have income in the background. If it's a development income, yes, your accounts, income and expenditure schedule, just so they can get to know you. Obviously, the proof of planning, the business plan. Well, that covers a multitude of sins, but the main thing it covers, and the main thing that we started with this presentation, is your CV. We need your CV to demonstrate that you can actually complete this project. And then details of any contractors you're using, CVs for them, or just their web pages, so we can see, are the groundworks team up to muster, as they say? Can they do the work that you contracted them for? And it'd be nice to see the drawings, because that can bring to life the development you're looking at. Right, so how long does it take to get the funds? Well, as I said, with the sort of banks, the Tier 1 lenders, we can get a meeting, an example, just last week. We had someone sort of say, oh, I need some funding. We actually got the meeting with the bank next day. So we can easily get the meeting within a week. If we've got all the information together, which we tend to do, they comes in quite rapidly. The bank manager can take the application to his credit committee within a week and get an answer within sort of 2 days. So we can get sort of credit-backed terms within sort of a week and a half. But then it starts to take a little bit longer, in that we need the valuation. So the valuer gets instructed. The valuer has it normally takes a week for him to get out on site, and then 2 weeks to write the report. So that takes a little while. Valuation comes back. As I said, he looks at sort of value of the site now, the cost of works, and end value. But then it goes to legals, and that's where a lot of time can be taken up. It takes 4 to 6 weeks. So, to be honest, I don't want to sort of be over ambitious. So I always like to say, you've got to expect, on average, 3 months. Well, at worst, 3 months to draw down. So you have to bear that in mind. Now, interestingly, people are interested. I've just been sort of debating with someone on emails today, a developer, sort of how are the funds released. If you have a property loan to start with, so the banks and lenders are funding part of the property, that gets drawn down. As soon as the legals are finished, you can have that cash. And then, if we're funding, say, 100% development costs, you can also get drawn down sort of the professional fees that you've encountered on day one. You can get those drawn down. But then it is invariably retrospective, in that the independent mortgage surveyor will then come out every 4 to 6 weeks to have a look how much work you've done, and then write a little report to the lender, and they will release the cash. Okay. An IMS will charge, on average, £650 per visit. But it's up to you on a lot of occasions how many times you call him out. If you cash rich, you don't need to do sort of lots of drawdowns. You don't need to do sort of 15 drawdowns. You don't have to call them out every 4 weeks. You can say every 6 weeks or every 7 weeks. And there are, on some occasions, less than £500,000 projects. We can find lenders where you don't have that extra cost of an IMS, because you can have a look at it and you think, well, if I've got 10 drawdowns, that's 6,500. He's got to do his initial report. That tends to be £2,000. So it can turn up to quite a costly charge of £10,000. So if we can find you a lender on smaller projects that will have the costing signed off by your architect, your architect, as long as he's got the appropriate qualifications, that will be a considerable saving. And I say we can find people for smaller projects that do have experience, lenders who can achieve that. Yes, so finance will vary depending on the circumstances, as it says there. So lender, if you bought a plot of land, for example, 3 years ago, and it was just a plot of land and there was cows and sheep grazing on it, and you obtained planning, obviously that value of the land would increase. So a lot of lenders, if you've worked up the land, will allow you to have that increased value as part of your contribution. So they would count that into the equation. If, however, you've bought the land with planning, but you've managed to buy it really cheaply through a contact, they won't look at that enhanced value. So it's really, you've got to have put some work into enhancing the value of land, but they will then look at that as your contribution, which is quite a nice way of putting your contribution in. It is possible to get 100% of build costs. I see it all the time, and also some on land. So it really depends on how much the costs are compared to the value of the land. So it's a little equation there. I always use, because I've been around the block a bit, a third, a third, a third. So the land's worth a third, the build cost a third, and then the profit's a third. You don't go too far wrong if you look at it like that. But we know how to structure the deal, and because you've got to remember, you've got to pay for the development up front, so it's a retrospective drawdown. Sometimes I always say it's best to take a little bit out of the property if you can, so it gives you the liquidity, because you don't want it tight in cash terms. So if you can take some money out of the property, that's all well and good, because it can fund the first part of the works. Right. You have to bear with us. We're having some IT issues. Oh, there we go. Excellent. Right. So I've got the first case study here, which was an experienced developer, land with full planning permission, and they've owned it outright since 2004. So a nice, clean scenario. So as you can see, property value 175, the build cost 250, total cost 425, end valuation, the valuer agreed, was 525,000. So the profit 100,000 is in line with the ratios that we spoke about earlier. We're 23% in costs and 20% on GDV. So we managed on this occasion through a lender. We got agreement to 250,000, i.e. the build costs on a loan, which equated to 60% of the loan costs and 48% of the GDV. Interest rate of 5.5 and over 24 months with interest rolled up. But the good thing on this one, right, the lender's fee were a little bit high at 2% in and 2% out, but there was quite a significant saving because we managed to get agreement from the lender that the developer could use their own architect. So as I said, on a project like this, it'll be between £10,000 and £15,000 saved in that respect. So looking at, this is the same property, as you can tell by the picture. It's the same property, but we went to two lenders at the time. So this is the other aspect that we found. We found another lender who would lend on it. So it's the same figures, but this one had a rate of 7.5%, but it was fixed. Okay, lender's fees were down, so the out fee was 1% compared to 2% in the other example, but the lender required IMS. So as you can imagine, that added to the cost. So the client at the time went for 1A, as you'd expect. So this is the second case study. We were looking here at full-time city trader. So it's not really a developer, is it? But they had sort of buy-to-let and done some significant extensions, etc. So they had a little bit of experience, but they had a good level of outside income as well. So on this particular case, we were looking at sort of a property value of 165 on the land, build cost of 215, total cost 380. Again, the GDV is 475. So as per previous examples, there was a 25% profit on costs and 20% on GDV. They didn't need a land loan, but 100% of the build cost, which is fine. And you see it's a nice 5% rate there, variable. So you can see it's from one of the high street banks there. We decided for an 18-month turnaround, and the lender's fees were 1.5 in, 1.5 out. But because they didn't have the full sort of background, the lender did insist on an IMS in this case. But it's all progressed very well, this particular case, and yeah, it's on the market now, so that's fantastic. And this one's a little bit bigger because we do quite substantial developments. We had someone who hadn't done out-of-ground development, a new build, but they had a significant buy-to-let portfolio and once again completed refurbishments and a few extensions during that time. But they had a skill set of being sort of, full-time accountants. They knew how to structure, they knew how to project manage. So we managed to find a lender. When they bought the property, it didn't have planning. So when they bought it, it was 520,000 with planning. It sort of grew to 850. The build cost there at 1,815, so a total cost of 2.335 million, and a GDV of just over 3 million. Profit 710, and you have a look. Oh, that's quite good. 30% on cost. That's higher than average. A lot of that is because of the fact they enhanced the value of the property through getting the planning, and 23% on GDV. So yeah, good profit margins in this one. So they already owned the land and profit, so they didn't need to borrow on that. But we got them the full 1.8 million in the build costs for someone that hadn't had any experience on doing a new build. And the new build actually was not absolutely straightforward. There were 9 flats, so it was quite a significant property. 18 months term with interest rolling up, and lender's fee 2% in, 1.5 out on the loan, and as you'd expect with a project like this, the lender insisted on having a monitoring surveyor. So that's my examples. We do sort of work very hard from you. I think the key is to contact the right lenders at the outset. We have access to many tier 1 and tier 3 developers. We deal directly with the lenders, and I sort of head up the development program here. We have tons of experience, between us, 100 years of experience, and our business model gives us a sort of preferential treatment. So we do a lot with sort of the lenders. So that's why we can get people out there at the meetings very quickly. As I mentioned just the other day, within a day we got someone on site. And we do case manage from initial inquiry to completion, hold your hand all the way through the progress of the case. To the extent we help you with completion of the forms, come to the site meetings. So we do help you all the way through the process. What will happen is, I will take questions in a minute, but what we will do is we will send you each a recording of this webinar, along with sort of an income and expenditure form and a commercial application, so you can see what we need. But if you have any questions or need to any help, there are my contact details for later. But fire away with some questions if you have any. Please bear with me. I'll read this. So thank you for the comments about the presentation. What does a JCT contract mean? Well, A JCT contract is a standard contract. It's a Joint Contracts Tribunal. That's what JCT stands for. And it's a company that's produced standard forms of construction for the construction industry. And it's sort of turned into an industry standard as such. So lots of lenders do like to see a JC contract. Sorry about that, technical difficulties, but yeah, JD, if I could come back to you've asked a question with regard that should you contact us before you get planning. I always think it's good to actually contact us beforehand. I'm dealing with a couple of people where they're just trying to firm up the planning or change the planning, but we can get the lenders on board early days. So it's always good to put the information together at the outset and take things forward. You can apply to try and get lending before you get the plan permission in place, but obviously it'd be subject to you getting full planning. So you don't need to exchange the contract first. You can come and talk to us at the outset, and then we can see how we can put that in place for you. Right. So a new build, Mark, this is your question, sir. Sorry. Yeah, a new build. You don't always have to do it as a limited company, but I'm trying to see if you say a domestic build. If that's a build for your good self, it's a self build, and you'll be moving in, so it becomes regulated. So we might need to take this one offline and have a chat and see how that works. Oh, Mark, I see you've put another question there. It's a buy to let. So yeah, you don't have. You could do it in your personal name or in a limited company, but you'd need to take tax advice on how to take that forward. JD, thank you for your inquiry regarding will the lender always look to secure the loan by way of a first charge on the development site? Invariably so, yes. I mean, that's their first point of recall, so they will need to take a first charge on the site. However, if you have an investor that wants to take a charge on the site, they have no problem in allowing a second charge to be put in place. Taylor, I've got your second email regarding the planning permission. If you make an offer subject to planning, then we can get indicative terms from the lender, most definitely. But of course, planning can take a long process. But it'd be good to know for your position that you get an offer, indicative terms, and they've gone through everything, so you're nice and secure. So that would be the best way forward for you. Are there any other questions that people have? Right, I've got a question from Michelle. Her question being is, what type of development should a first-time developer look at doing? What would the lenders look most favourably at? Well, Michelle, I would have a look at sort of a simple development to start with. If you're brand new to developing, a single unit, you saw that the single property we looked at in the examples, on a nice flat bit of ground, so there's no major groundworks, and ensure that you surround yourself with the right professionals, the right contractor, and the sort of QS, an architect, and then you should be able to secure funding. But that would be the best way to go forward, Michelle. Lovely. Okay, we've had no other questions. Thank you very much for your time today. And if you do have any sort of questions you need to ask, my contact details will be forwarded to you. Lovely. Thank you. Bye-bye.